Today's interview is with Brian Kochendorfer. I'm sorry if I butchered your name again. Another one to add to the list of names that I've butchered, but phenomenal interview today. I really enjoyed today's interview. Brian's a broker out of Chicago, Illinois, and he talks about how he was around for the 08-09 crash and what he kind of learned from that process, and then how he's then scaled up. You know, he started buying in 2019 and has since grown his portfolio to a sizable amount. He talks about the deals, the financing, all that good stuff, and also how new investors should work with brokers. So if you're a new investor and you want to understand how to work with brokers, stick around for this interview because there's some tips there for you. As always, like and subscribe on Wrestling with Real Estate, the YouTube channel. Go to the WWRE Podcast and give me a 5-star rating if you think it's worthy, and of course it is. And I'm looking to speak to as many of you as possible. If you're interested in real estate and you love real estate like I do, or if you're just starting out, I'd love to get on a call with you and talk some more real estate with you personally. If you go to the link in the description down below and schedule a 30-minute call, or you can go to the wrestlingwithrealestate.com website and sign up there. There's a link there. I'd love to get to know you. But before that, enjoy today's great interview with Brian. Hello and welcome to Wrestling with Real Estate, where we look to chokeslam all your real estate problems. I'm your host, former WWE wrestler and now Cirque du Soleil performer, and of course, multifamily real estate investor, Barri Griffiths. Now today we're joined by Brian. How are you doing, Brian?
Good, Barry. How are you today?
I'm doing fantastic. Looks a little cold where you are from that background.
Yeah, it's the old Star Wars background, but yeah, here located in Chicago, so it's actually 70 and sunny today in November, so cannot complain at all.
Oh, nice. When does it really start to get really cold there?
Usually around now, and we got a little warm front coming in for a week or so, high 60s, low 70s for a while, so we're going to enjoy it while it lasts.
And then how cold does it get when it gets cold?
It'll get down to 0 degrees in January, February.
Okay, yeah, that's a little rough.
It's not fun.
I'm sure. Yeah, we don't have that problem here in Las Vegas. Well, cool. Well, thanks for being here today. Thanks for making time to be on the show. I'm really excited to kind of dive into today's conversation and get to know more about you. But before that, can you tell us a little bit about your background and kind of what you're focused on right now?
Yeah, and thanks again for having me. Very excited to be here. So my background is I've been a multifamily broker for the last 14 years in the Chicago area. So I've been focusing on the sales of properties anywhere from 12 to 200 units throughout the city and suburbs. I started passively investing in other people's syndications about 3-4 years ago. So I've invested in a couple syndications, and then just about a year and a half ago, started acquiring properties on my own with a couple partners in the Indiana market. So I'm up to about 320 units total in Indiana, and just actually acquired one yesterday. So pretty exciting.
Nice. Well, congratulations on the purchase yesterday. That's it. That alone is exciting. So, yeah, congrats on all your success. So, you say you're a broker, right? You on the transactional side of things. How did you end up there? How did what was your prior history to that, and what made you choose to go that route?
Yeah, so I actually started in the middle of 2007, and I was working in commercial insurance at the time. I wasn't making a lot of money, and I was at a point though where I was starting to get some clients in the insurance world, and I knew I was going to start making good money. And it almost scared me because I knew that if I started making good money in insurance, I would end up stuck in that industry, and it just wasn't something I wanted to do. So I made the decision to leave that field. I was always interested in real estate. I kind of grew up around a couple rental properties that, either friends or family had when I was a child. So it was always something that interested me. And in talking to some people, I thought that getting into brokerage would be the best way to make a living while learning about the investment space, and then ultimately start investing on my own. The challenge I had was I started in mid-2007, like I said, so it was about 6-8 months before the recession. So my first 4 or 5 years were pretty tough. I was waiting tables on nights and weekends just to pay the bills. But I knew that if I could stick it out, that in the long run I'd be much better off, and I'm glad I stuck it out.
Yeah. Wow. Yeah. So maybe talk to us a little bit about. I wasn't around. I was around, but I was in the UK at the time, and I wasn't really paying attention to real estate. maybe and especially on the commercial front, we hear all about the single family homes, people losing their homes all the time during that Great Recession. But talk a little bit about, especially in Chicago, you were in Chicago at the time, I'm guessing, how things were then during that recession for multifamily.
Yeah, so back then I was doing a mix of, sales and leasing for retail, office, and multifamily. The multifamily space, it was better than retail and office for sure. The challenge was lending at the time when, the banks just stopped lending for a couple of years. When the market really crashed, everybody had bad debt on their books. So even if you had a good buyer and a good seller, banks weren't lending. And so it was a lot of owner finance deals, a lot of creative finance deals. So it was really tough to get deals across the finish line, and sellers had to take a discounted price even if the property was performing for the most part. So there was a good solid 2 years where it was really tough to get financing out here, and eventually things started loosening up, but it took a while.
Was it so? Did that result in deal volume being way down? I don't know if you can hear me, Brian.
I'm sorry, can you say that one more time? The screen froze a little bit.
Yeah, it froze on my end as well. Yeah, absolutely. I'll just edit that part out. So did that mean that deal volume was way down because the banks weren't lending?
Yeah, deal volume was quite a bit down, and also the size of the deals was down. So if the current company I'm at, they did almost as many transactions, but the size of the transactions was down, 50, 60, 70%, because deals were just selling for so much less at the time.
And what kind of discounts, were they looking at that point?
At the time, you could, things were 50% of what they are today. It was significantly lower, and a lot of distressed assets. A lot of people got stuck. They were trying to do condos, make apartments into condos. They got stuck, ended up having to turn them back into rentals. And then those properties, some people that bought back in 2010 to 2013 got great deals on those.
Yeah. You mentioned something there that was interesting, that because financing was so hard, they were getting a discount, even though the properties were still performing. So for buyers, that's a phenomenal deal, right? You're getting a cheaper property just because the financing isn't hard. The property is still performing at the same rate that you'd be willing to maybe pay a higher rate, and you were getting that great deal.
Yep, exactly. And even though they were getting a good deal, they were still having a hard time putting good debt on it. So the buyers were taking some risk as well, because they were either paying cash, doing owner financing, or putting up more of a down payment to get a bank to lend on them.
Is that owner financing, was that more prevalent at the time?
At the time, yeah. I did a handful of those, where today it's very difficult for owner financing.
Right. Yeah, that's really fascinating. So from there, you said 4 or 5 rough years. Was it around 2012, 2013? You say that things really started to pick up?
Yeah, I would say in 2012 things started to kind of turn the corner, and then from there things have been pretty active and pretty stable since then. But 2012 lending started loosening up, so banks were lending again on multifamily. A lot more buyers, since we'd already kind of hit the bottom and the uptick started to happen. A lot of buyers came out and started buying again. Sellers who had been holding on, they were ready to let go at the time. So it got very transactional starting in 2012.
Yeah. Well, being around that time, I'm sure there were some lessons that you learned, maybe not from yourself, but from seeing what was going on. Were there some big lessons and takeaways that you learned from that time?
Yeah, the people who got affected the least through the downturn was multifamily owners. So like I said, for those few years, I was doing a mix of retail, office, and multifamily. And it was around 2011 that I switched over and focused strictly on multifamily, because I realized that the retail and office owners, they were the ones that really got hurt during that time. But the multifamily owners stayed okay. Even if they, had a couple tenants that left, they still, for the most part, collected their rents. Their cash flow didn't really go down. So that's when I made the full switch to multifamily.
It's interesting. Yeah, I've heard that quite a few times, that multifamily was one of the best asset classes during that time, especially if you weren't over leveraged and you had some reserves, right? And you had long-term debt, so that you had, you could ride out that storm at that time. That's really interesting. So in what year did you start investing?
So I started passively investing, I think it was 2016 that I did my first passive investment. I invested into a syndication, and then I did another one in 2018, I believe. And then 2019 started investing actively.
What made you go the passive route first?
It was a combination of a couple things. One, I was still doing a lot of brokerage, spending a lot of time on that, really kind of building out a full brokerage team at the time. I also wanted to do a couple passive deals in other people's syndication to see how they ran their apartment complexes, kind of get a behind the scenes look, also help build up a couple streams of cash flow outside of brokerage income. So it was, multifaceted decision. I wanted other cash flow. I wanted to see how other people operate their buildings and just kind of see, the ins and outs from their perspective, what they did right, what they did wrong. It was more of a education for me.
Yeah, I'm sure the 21 in 2016 is done pretty well, right? You could almost buy anything at 2016, I think, and even 18, I'm sure, but 16 especially. Things have risen up so much, right? A rising tide raises all ships, type thing.
Yeah, I think both were set to be refinanced this year. Then COVID put those plans on hold, but my guess is they're both going to refinance next year.
Okay, nice. So then you start in 2019. You decided to go the active route. So as you mentioned, guessing the plan the whole time was to get to that active point, right? To have your own deals and be the main guy on those deals.
Exactly.
What was your first purchase then? Your first active purchase?
So first active purchase was a 100-unit property in Northwest Indiana. It's a little town called Chesterton. It's about an hour outside of Chicago, and I love the Indiana market because it's very landlord friendly. It's close enough to Chicago where I can get there and back in a day, no problem. And I think the rental market has been really increasing the last couple of years. And Illinois has actually lost people over the last couple of years, and Indiana has been a population growth state. So, but yeah, that was the first one. We did a 100-unit property, and we closed on it in fall of 2019.
Oh, yeah, that's cool. First deal, 100-unit for your first deal is pretty impressive.
Yeah, it was a nice one.
Yeah, why don't you invest in Chicago then? 'Cause as you mentioned, you guys are in Chicago. You're a broker there. A lot of people might think that it makes sense to invest there.
Yeah, a couple of reasons. I do have a couple smaller properties in the Chicago area, but one main thing is while I'm still active in the brokerage side, I don't want to compete with my clients. All of my clients, own and invest in the Chicago city and suburbs. So I really want to try to separate those two things where I don't want to be competition for my clients because then they're just going to think that I'm just buying the best deals and then giving them the second best deals. So I'd rather keep those relationships on the up and up. Also, Chicago is very tenant friendly as far as the landlord tenant laws. I mean, during COVID, they put in an eviction moratorium starting in March of 2020. It's going to go at least through the end of the year. By the time they open up the eviction courts again, it's going to be 12 months that everything's going to be closed down here. So it's very difficult from a landlord-tenant law perspective. Chicago's very difficult, and you got to really understand those laws. Also, the tax situation in Illinois in general isn't great. Illinois has a lot of debt, and there's really no way out of it except to keep taxing people. So taxes have been going up and up over the last several years. So Indiana is just a little bit more stable, more landlord-friendly. And like I mentioned, in Illinois, we're actually losing population every year. In Indiana, there's some growth in population.
Interesting. While you touched on that, what are you seeing in terms of the Chicago market now, in terms of everything that's happened pre-COVID, right? Post-COVID, sorry, during this pandemic, everything that's happened.
Yeah, I mean, it's still in Chicago. It's still kind of during COVID. It's not quite post-COVID. Just last week we shut down all restaurants and bars again for indoor seating. So it's only takeout here. A lot of places are closed down. We're not quite in full shutdown mode, but we're in partial shutdown mode here. Like I mentioned, the eviction moratorium is going to be in place at least through the end of the year, likely into the spring of 2021. So we're still in the middle. We're not quite at post-COVID yet. I would say the brokerage market has picked up quite a bit the last 3-4 months. People are starting to sell. There's still a fair amount of buyers out there. So the lending market has stabilized a little bit, where it kind of went crazy there for the first couple months in March and April. The lending market settled down in May and June, so lenders are willing to do deals again. So it's just been slow and steady. It's consistent, been focused on trying to just maintain client relationships, trying to help them as much as possible, and just get through it month at a time.
And is that eviction moratorium you see causing any distress for owners there?
It is. Some owners are okay, but some owners, if you have a smaller property, if you have a 12-unit property and you have 2 or 3 tenants not paying, you can't evict them. There's nothing you can do. That's 25% of your monthly income. That hurts when, it comes time to paying a mortgage. So it's another reason why I like to focus on properties really 20 units and up, because if you have a 6 flat and 2 tenants aren't paying, it's a third of your income. If you have a 30 unit and 2 or 3 tenants aren't paying, it's only, 8 or 10% of your income. So,
yeah. And do you think there'll be some opportunity there because of this? You think from
potentially? Yeah, I think depending on how long the eviction moratorium goes, it could get interesting as we get into next spring. Because I think a lot of owners are starting to feel some pain right now, and I think some, they're just trying to hang on, pay the bills, stay steady. But in the city itself, rents are down as well. So as you know, there's been a lot of violence and looting in downtown Chicago since all of the businesses are closed. People are working from home. A lot of people are moving from the city to the suburbs. So in the city, rents are down, sometimes between 5 and 15% compared to where they were a year ago. The suburban rents are doing okay, but if owners have some bad tenants that aren't paying rent, they are feeling some pain.
Yeah, yeah. You wonder, across the board, if that's something that could cause pain. If rents are dropping, plus you have that higher economic vacancy, right? You have physical vacancy, and you can get them out. It's not like you can get a new tenant in there, so that's more painful than not having anyone in there at all. And you wonder if those two combined factors could, down the road, and I mean nationwide, could cause some issues maybe.
Yeah, I think the downtown market's going to suffer for the next 2-3 years because, again, the office market's going to change. People are going to be working from home for the most part for at least another year. Those people have no reason to live downtown when everything's closed and their office is closed anyways. So the reason people want to live downtown is to be by the lake, to be by all the restaurants and all the activity. And when everything is closed, there's no reason to be there. So a lot of people are just coming out to the suburbs, enjoying more space. And so the suburban rents have actually been okay, but the city rents have gone down quite a bit.
Yeah, that's interesting. That's interesting. So back to the 100-unit deal that you did.
Yep.
How did you find it? I'm guessing broker relationships.
Yeah, that was through a broker. We'd been looking in the Indianapolis market for 4 to 6 months before that, reaching out to all the brokers down there, staying in touch with them, and then the Indianapolis, one of the brokers down there that we knew pretty well, he called us. Them and their Chicago team were actually going to be working on a property together in Northwest Indiana. So he called and gave us a heads up about it a couple of weeks ahead of time. So we got to go drive by it and at least see the property, do some preliminary research, and it did go to market. So we bid on it. It was a little bit too far north for the Indianapolis buyers. And at the time, not a lot of Chicago buyers were looking in Indiana as much as they are now. So it was just kind of a unique opportunity where it was perfect for us. And we went through the bidding process, and after, we actually made our final offer, the seller rejected it. Then about 4 to 6 weeks later, he came back and said, okay, if you guys are still interested, we'll move forward. And so we got the deal under contract, summer 2019 and closing the fall.
Oh, well, congratulations. What, if you don't mind me asking, what did you guys pay for it?
So we paid about $8.5 million, so about $85,000 per unit. The plan was to put in $1 million in renovations. So about 2/3 of that was going to go into unit renovations. We're going to upgrade about 60 to 65 units, which we're already at about 60 right now. And the other third of the CapEx budget was going to go into exterior type renovations at the property, some landscaping, had to improve some lighting, some parking lot work. We updated the clubhouse and fitness center. So did $1 million renovation total, and we're just about through that renovation plan right now.
Very cool. What, where were rents, and where are you hoping to get rents?
Rents at the time were probably just under $1 per square foot. We're getting about a 10% increase right now. So we're hitting our margins. They varied. We have 1-bedrooms all the way from smaller 1-beds to 2-bed, 2-bath townhouse style units that are 2 floors. So we have, I think, 7 or 8 different unit plans. We're getting anywhere from, depending on the level of renovation, I would say from 70 to 175 in rent increases, depending on the unit. So the plan is to finish the rest of the unit turns, get the property stabilized, then likely pull out a supplemental loan in about a year from now to get back some of the cash, because we did a Fannie Mae agency loan and then they gave us the rehab dollars on top of it.
Oh, wow, nice. Okay, so that helped a lot. And then you guys, what kind of LTV do you guys get on that?
So we got 75% of the total project cost. And I want to say the rate was around 4% at the time. So they're a little bit lower now. Yeah. But we did a 5-year fixed loan, or I'm sorry, a 15-year fixed loan with 5 years of interest only.
Wow, what a great loan.
Yeah.
What, who you say you keep saying we, who's part of your team? And, most of us understand that you can't take a 100-unit property down by yourself, right? It involves a team, but who's part of your team?
Yep. So on that one, I did that deal with 2 of my brokerage partners, and then one of our clients who's also a friend, and he was looking in the Indiana area as well. So we found the deal. We approached him with it to see if he would have interest. So he was our main capital partner, and then the three of us put in some of our own money as well. So the four of us did it as a joint venture.
Nice. What obviously having that loan to cost helped a lot with having to raise less money, right? But still, what kind of rate? You must have had to have a decent sized raise on that one, right?
Yeah, well, like I said, we structured it as a joint venture. So we just split up the equity. So we had one primary partner. So he put in more of the equity. So he's the majority owner. And then we each, the three of us on my brokerage team, we each took a smaller percentage of the deal and then a small acquisition fee. And we're doing all the asset management and overseeing the construction.
Oh, nice. Also, it wasn't a syndication, and that's great that it was a joint venture. Okay. Oh, nice. On 100 unit. That's impressive.
Yep. Straight joint venture.
Yeah, it makes it a little easier, I think, right? You don't have all that red tape and that legality to kind of go through. Obviously, there are still legalities and everything that you have to make sure is above board, but
yeah, that part was all smooth.
Very nice, very nice. And the plan is to hold it long term, or is the goal is to?
Yeah, plan is likely to hopefully refinance in the next 12 to 18 months so we can pull out some of our initial equity that we put in. And then we're just going to hold it long term. It should cash flow by year 2. It should be a 10% cash on cash return. So once we get some of our equity back, that cash on cash will go up. So it'll be a long term cash flow play.
Nice. You mentioned there the supplement. I can't say the words. Supplementary loan. You guys are going to take out. For those people that don't know, what is a supplement? I can't even say.
Yeah, so a supplemental loan is basically, you can do that a lot of times with agency loans with Fannie or Freddie. So what it means that if you add value to the property, as long as there's 7 years left on the loan and it's not a small balance loan, I believe it has to be over $3 million, the loan amount, you can take out, it's almost like a refinance. It's a supplemental loan. So you can take out a secondary loan on the property at today's interest rate, which would allow you to potentially get some cash that you invested back, some of your equity back. So we, in that particular example, our total all-in cost was about $9.5 million between the purchase price and renovation. At the time we closed, the post-rehab appraisal came back at $12 million. So if that appraisal holds when we go to do the supplemental, we'll be able to take out a 75% loan of $12 million, which would be $9 million. So we're going to get most of our initial equity back, or at least half of it back.
Nice, very nice. Yeah. And that's one of the beauties of multifamily, right? You can force that appreciation, improve the property, increase rents, lower expenses, and improve the value of the property. And you can kind of do things like that, creative stuff like that, with having a supplemental loan. Very nice.
Exactly.
Yeah. So what was your second deal? Where did you go from there? What was your second?
So the second deal was actually a different client of mine who's actually a foreign investor. I've sold him 4 or 5 buildings over the years. He wanted to buy a couple properties in the Chicago area that we had under contract for him. And he asked me to come in on the properties with him and kind of do the asset management and oversee the construction and rehab. So we actually closed those about a month after I closed the one in Indiana. Wow. They were 2 properties we closed together in Chicago, a 31 and a 45 unit. So those were more going in initially. One of them was half vacant, do a bunch of rehab. The goal was to refinance it by the end of this year or early next year. That project's going to be a little bit slower because of COVID. We had to, slow everything down. We couldn't move tenants out. But so I ended up closing those 2 last year. So the first year was about 176 units total.
Nice. And that was another joint venture?
Also joint venture. Yeah, they did some, they brought in some friends and family money on that one, but it wasn't a full syndication. So.
Okay, nice. And you weren't scared of 50? You said it was about 50% occupied, about half full when you guys took one of those properties over.
Yep, one of them was only about 50% occupied. I actually liked that because we were getting it at a pretty good rate as well, pretty good price. But the fact that it was half occupied meant that we could go in and renovate 50% of the units right away. So we'd be able to renovate those and turn those units around within the first 90 days, which was just in time for the spring leasing season this year.
Oh, that worked out perfectly. What kind of financing did you get on that? You have to get bridge debt, or
We did bridge debt on those. So we did a 3-year bridge where it's interest only for the first 3 years. And the goal is to, again, refinance those into permanent long-term debt. Our hope was to do it by early 2021, but it's probably going to be 12 months from now, late 2021, by the time that we can refinance.
because of COVID or because of other setbacks?
Yeah, because we had to shut down in COVID. Obviously, we can't evict people. Part of the plan for one property was there's a lot of tenants paying lower rents. So as we started renovating the units, we wanted to offer those tenants the opportunity to come in and lease one of the newly renovated units at the higher rent. But since they were on month-to-month leases, if they didn't want to, we can have those tenants just move out. So once the eviction moratorium came in, we can no longer move any tenants out. So now the rehab plan is just going much slower than we had anticipated.
Very interesting. Very interesting. Um, you said there as well that the second investments were a month after the first investment. How were you able to, obviously you're a busy guy, I'm sure, working a full-time job. How were you able to balance all of those things, doing your W-2, then both those investments?
Well, the good thing about being a broker, you're actually a 1099 contractor. You're an independent contractor. So I'm in control of my own time. I also have a full team with brokerage. So I have a team of 6 people total. So it's not just me on the brokerage side. So I was able to have other team members help out with certain aspects of deals. And on the investment side, it was certainly busy those first few weeks as we were getting everything under control and getting the rehab plan started. But a lot of nights, a lot of weekends, a lot of early mornings. I'm an early riser in general, so I'm usually up by 5:30 or so. So get a head start on the day.
Nice, yeah. And then what was next from there then? So at this point you're at, between those two properties, you're at how many units?
Between those total, I was at about 176.
Okay.
And then going into this year, my goal was to hopefully acquire another, 250, 300. Obviously, COVID slowed things down a bit. I was able to pick up a couple small properties in the Chicago area, just with a couple of friends that were off market. But I closed on a 53-unit property in Indianapolis in September with my partner, Mandy McAllister, who you know.
Yeah.
And then just yesterday, actually, I closed on another 58 units in the Valparaiso area of Indiana, which is, again, northwest Indiana, about an hour, 15 minutes outside of Chicago.
Nice. Well, maybe talk a little bit first about the 53 units. How did you find it to start off with?
So that was actually the same broker that sold us the first 100 units in northwest Indiana.
Mm-hmm.
And they had that property and we looked at it through them. It was a great little property. The owners of it, it was formerly an assisted living facility that they fully renovated. So it was a small enough property where it kind of gave us a footprint into the market. Also, given the time, it was in the summer that we started looking at it. COVID was still, a lot of shutdowns in place. Doing any kind of full rehab project in a brand new market that's 3 hours away made me a little nervous. So I liked the fact that it was fully stabilized and cash flowing from day one. And when I checked into the debt on it, we were able to get such a good interest rate and such a good loan that it just made sense. It was going to cash flow from day one, really high. So, we put in, again, 15-year fixed debt, rate of about 3.7, but 8 years of interest only. So it's just a really high cash flow deal. Now, it's not going to be a home run deal that's going to make anybody rich, but it's a solid single or double that I think is in an appreciating area. And, we won't have any CapEx to do over the next 5 to 7 years. Our first full month of ownership, we had 100% rent collection. So it's just going to be a great cash flow property and a good entry into a market that I've been really trying to get into.
Yeah. You said two interesting things there. For one, as you know, as being a broker yourself, you know this, but once you start closing deals with people, right, you're going to get more deals because obviously you have that reputation and people know that you're doing deals and that you're serious. And that it's interesting as well that that it makes sense that during COVID, you didn't know how the situation was going to play out in terms of being able to do renovations, get people out, all that stuff. So if you have an asset that makes a really good cash flow day one, and you don't have to worry about all those CapEx items and renovating units and getting tenants in and getting tenants out, it makes things a lot more stable. What kind of cash on cash were you guys looking at day one?
It should be north of a 9 year one and over 10% year two.
Wow.
So pretty strong right out the gate. And that was intriguing because, it was just good cash flow for all of us for next year. And then B, like I said, it was just a low risk entry into the market. A worst case scenario, we're a little bit off on cash and it goes down to 8. But, we stress tested it quite a bit. We could absorb it up to 40% vacancy and still pay the mortgage. So we felt pretty good about that.
Yeah. Did you, and then on that one, what was the structure again? Was it a joint venture?
That was another joint venture. It was Mandy, myself, and actually the same equity partner we had on the 100 units. So he joined us in that one. So it's just the three of us, straight joint venture.
Oh, yeah. He sounds like a good friend or a good guy to know, that guy.
Yeah, it's honestly one of the best parts of being a broker is over the years, I've been doing this for 14 years now. People aren't just clients. When you build relationships with people in this industry, a lot of these people become friends. And in a lot of cases, these friends become business partners. So it's just kind of a really, cool way that it all syncs up together. And it's been something that I've really enjoyed a lot.
Yeah, very cool. And so the deal that you closed yesterday, for anyone interested, it's November 6th today. So it was November 5th that you closed. Tell us a little bit about that one.
Yeah, so that's a 58 unit property in Northwest Indiana. Found that one through a property manager that we know. One of my brokerage partners is, was looking around for one of his clients in Northwest Indiana. We've known this property manager. We showed a client of mine who's also partners with me on a couple smaller deals in Chicago. We showed them a different property in the area. It didn't work. As we were talking to the property manager about other areas of interest, he just happened to mention, well, hey, I'm managing a 58 unit for this guy. He's thinking about selling and retiring. Would you want to look at that one? So we went over and looked at that one, and it was perfect. It was a great deal. It was a really solid building. The units were dated, so we can do some renovation and increase rents. But it was fully occupied, cash flowing day one. We're going to be able to renovate units as they turn over, and then should be able to execute a refinance in about 18 months to pull back most or all of our equity on that one.
Wow, sounds like a killer deal. It's interesting that you guys are buying now. There's a lot of talk out there that people are waiting, people are kind of seeing what's going on. What gives you guys comfort level to be pushing ahead right now?
Well, two things. Like I said, on the Indianapolis deal, that was 53 units. We got a really good loan on it. We have 8 years of interest only, under 3.7% rate. And when we stress tested it, we could go up to 40% vacancy or 40% of the tenants not paying and still pay the mortgage. So it felt really good about that particular deal. On this Valparaiso one, it's a deal that the rental market is really strong in that pocket right now. The rents are under market currently. And again, we're not going to clear out the building to do renovation. We're just going to be turning things over unit by unit. So as units turn, we can take our time with that one. So it'll still cash flow all along the way and be able to pay all the debt service. But as we go, we're going to be able to slowly increase value in the next 18 to 24 months. So I thought both of those were pretty safe, given the neighborhood, low crime areas, low vacancy rate areas. Each area, the vacancy rate is only 4 to 6%. And we could absorb each one of them 30 to 40%. So,
what kind of debt did you get on that one as well? You get some.
On that one, we did a bridge to permanent loan. So I think we have a 24-month bridge, then we're locked into a 10-year fixed rate after that.
Wow, yeah, that's interesting that they're doing that. Seems to be, maybe my knowledge isn't that up to date to it, but there seems to be more bridge to permanent debt now, whereas before maybe you had to get permanent, get bridge financing from someone and then get separate long-term financing for someone. But obviously this makes the process a lot smoother.
Yeah, and it depends on the bank too. It's a local bank that there was a previous relationship with, so that certainly helps.
Okay, yeah. How were you able to get such favorable debt? You mentioned 15-year fixed, eight years of interest only. If you get 2 or 3, usually it's great, but to get 8 years of interest only is phenomenal.
Yeah, that's a straight Fannie Mae loan. So anybody can get that kind of debt. They liked that it was a newer renovation product. They know there was no capex needed. If you did a 10-year loan, usually the interest only is 3 to 4 years. If you do a 12-year loan, it could be 4 to 6 years. But if you do a 15-year fixed loan at this point, then they'll give you 6 to 8 years of interest only, depending on the deal. So, again, our plan is to hold long-term on those couple deals. So it was okay for us to put in long-term fixed debt. A lot of people don't want to put 15-year fixed rates on properties. They would rather put 10 to give them more options to sell down the line. But the interesting thing about that loan that's 15 years is if there's 7 years left on the loan, somebody can still come in and do a supplemental loan on it. So if we want to sell it year 7 or 8, somebody can assume our current debt at the 3.7% rate and then take out a supplemental loan up to 70 or 75%. So it could still make sense for all sides if we do decide to want to sell in 7 or 8 years. But again, as of now, our plan is to keep long-term and cash flow. Some people don't want to put that long of a fixed loan on a property because they would rather have the option to be able to sell earlier.
Yeah, because the issue with, for anyone wondering, why wouldn't you put long-term debt is the yield maintenance or the prepayment or whatever is on that. And
Exactly.
that can really hurt you if your game plan is if your business plan is to, turn around this property in 5 years and sell, and you have a syndication and you have 15 years, a 15-year term on it, you're going to be in quite a bit of trouble. I imagine you're going to be paying quite an amount in prepayment penalty. Whereas if you get maybe 7 years, a 7-year term on something like that, your prepayment is going to be pretty small. So, you've got to understand your business model going in, right? What is your business plan with this property? If you're going to hold it long term, well, it makes sense to kind of get that kind of debt. But if you're looking to hold it for 3 or 4 or 5 years, you want to look at maybe something that's a different option.
Yeah, and that's one of the advantages of doing things as a joint venture, because if you have investors in the syndication, the investors typically want their money back in 3 to 5 years, maybe 7 at the most. So they want to be able to go full cycle on a deal in that short of time. Mm-hmm. So without having outside investors, we can structure the deal however we want for whatever our goals are. And all of us wanted just long-term cash flow. That was our main goal for that property.
Yeah, that's awesome that you've been able to scale so much with joint ventures. It's usually to get that sort of amount of units under management or in your portfolio. Usually takes syndications to kind of grow that much. But I think it's phenomenal that you've been able to do joint ventures to get to that point. So that's really cool to hear.
Yeah, it's a fun ride.
Yeah, and as a broker, this is always interesting to me. For people listening who are starting out, right? I don't want to dive into this too much, but do you have some tips where how people can, because building that broker relationship is probably number one for me anyway, for sure, for finding deals. You want to rely on those brokers who have that expertise in talking to owners, and that's what you guys do all day long, pretty much. Not all day long, but it's a big chunk of what you guys do is speaking to owners, seeing if they're ready to sell, and finding those deals. How can newer investors work with brokers? What are some things that you would suggest for newer investors to start working with brokers?
Well, I think be consistent and follow up. At the end of the day, brokers, like you said, they're talking to property owners all the time. And there's a lot of time where property owners, they might not necessarily want to list a property, but they say, hey, if you have a buyer, let me know, I can potentially sell it, but I don't want to bring it out to the market. So usually a broker thinks of their top clients to call because they only have so many calls they can make in that kind of situation. And if somebody is following up with a broker consistently, that person's going to stay top of mind. So if a broker does come across an off-market deal and they have somebody who's been calling them, every month consistently saying, hey, what do you got? What do you got? That person might get a call for an off-market deal. Also, your first deal doesn't have to be a home run. I feel like a lot of investors, they want to hit a home run right out of the gate just to get, to pull the trigger on the first deal. And I really feel like if you can just pull off a solid single or a double on the first deal, the advantages of being able to say that you own X amount of units and that you've closed on the property is instant credibility for not only the broker you worked with, but for every other broker in the area that you're looking at, as well as lenders and other operators. It's just instant credibility. And it really is that law of the first deal. I mean, I wasn't even looking for the other two when I found it, and I was just under contract with the first one. Then I found those two. Then I, bought a couple more smaller ones earlier this year in Chicago. Then these 2 more this year. It just all, in the matter of, 16, 18 months, it all kind of snowballed really quick. So I would say, don't overthink the first deal. Just make sure it's a good, solid deal. It doesn't have to be a home run, and stay on top of brokers. Just, be polite. When they send you a deal, give them feedback. If you don't like it, tell them why. Don't just ignore them, because they're going to communicate with people who communicate with them.
Yeah, that makes sense. Yeah, and I think building that credibility, right, is key. It's having that. For one, having some level of knowledge, right? You don't have to be the most knowledgeable in the world, especially if you're maybe talking about smaller deals. Now, if you're trying to take down a 300 unit and you don't know what you're talking about, well, you might, you might not present that deal, or might not think that buyer is that serious. But understanding the terminology, right? Understanding what kind of investment criteria you have, understanding what the market is doing. You don't want to be saying, hey, I'm looking for a 12% cash on cash, and the market's only bearing a 6% on average, right? Or same it goes with cap rate, right? You don't want to be asking for a 12% cap rate, and the best you can hope for is maybe 5.5, 6 or whatever, right? So you've just got to understand what that market is doing, understand a little bit about the areas, or maybe not necessarily the areas. You can rely on the brokers that, but you need to have some kind of level of understanding up front, I would say, right?
Yeah, exactly.
Very cool, very cool. Well, interesting. So what's next for you, do you think?
Well, it's a interesting time of year. We're coming in mid-November now, so coming up on the holidays. My guess is no more acquisitions for this year. Still looking, going to be patient. Obviously, there's political craziness going on right now. The week after the election with things undecided and COVID cases are spiking up again. So in Chicago, some areas, businesses are shutting down. We'll see. I just want to take it slow and steady, be consistent, continuing to look for properties, look at opportunities, but I'm going to be a little bit more particular over these next couple months just to see how things, really shake out here.
Yeah, I think that makes sense. Cool. Well, this show is called Wrestling with Real Estate. So I like to incorporate some wrestling related real estate questions. So the first question is, what would your wrestling name be? If you had to pick a wrestling name for yourself, what would it be?
Oh, wow. What would the wrestling name be? That's a great question. I guess I would say something to go along with my name, something like Bruiser Brian, maybe. I think my first couple of years, I took a lot of bumps and bruises. So it wasn't easy when I first started in brokerage. Like I said, those first few years were really rough. And I feel like I took a lot of bumps and bruises those years. So something like that.
Bruiser Brian, I like that. One of my favorite wrestlers was called Bruiser Brody.
Oh, yeah, I've heard of him. Awesome.
Yeah, he was a great character. Every wrestler has a special move or a signature move. What would your special move be in real estate, you think?
Probably acquisitions. As a broker, I've been, finding deals and finding properties by calling owners over the last 14 years of my career. So I think acquisitions and working with other brokers is probably, what I'm best at.
Yeah, very cool. That's a great skill to have. I think, if you can find the deals, that's one of the biggest pieces of the puzzle, I'd say.
Yep, exactly.
What's been the biggest body slam you've taken in your real estate investing career?
Biggest body slam. Probably the two deals that I closed late last year in the Chicago area. I mentioned one of them was half vacant, which was great because we were able to renovate all those units right away. But the other one was fully occupied. We were starting to move some tenants out right when COVID hit. And because we couldn't move tenants out anymore, our rehab plan just got put on hold. So, at this point, it's a 45 unit property. We were expecting to have about 20 units done by now, and we have about half of that done. So it really kind of slowed things down. That and actually our first deal in Northwest Indiana, we had a lot of tenants leave right as we acquired it in December. So as we're doing renovations, going into COVID in March was our first main leasing month where everything just slowed down. So it just took a lot longer. So in both cases, we had setbacks that were just not expected. Thankfully, we underwrote conservatively on both, and we were okay. We made through the year fine, but definitely a couple body slams in those.
Okay. How are you managing all these? Do you have third-party management on all these properties?
Third-party management, yeah.
Okay, yeah. Cool.
Yeah. Most of them have their own construction crews too, so we use them for management and rehab.
Oh, nice. Okay, so that's makes it a lot easier for you guys with that. Instead of having to try and deal with contractors and find contractors, right? Do they do the asset the project management for you guys then?
We're overseeing all the project management. They're just doing the construction and then property management. So we're overseeing the asset and project management.
Okay, nice. So was there a moment that you were standing on the top rope, getting ready to jump, but you were too scared? What was it, and how did you overcome it?
Probably the very first deal that we bought when, I mentioned that the sellers didn't accept our offer at first. They came back around 4 to 6 weeks later and say, hey, if you still want the deal, we'll move forward. And that was kind of a moment like, we made our offer. Technically, it got accepted, even though it was, 6 weeks later. And there was just like this fear of, like, oh, crap, now what? It's one thing to like be looking at deals and making offers, but then when you get your first offer accepted, it's just kind of this anxiety that came over me. It was like, oh wow, this is real now, and what do we do? And so we talked about it, thought about it, and we just decided, you know what, we're going to believe in our underwriting, believe in our business plan, and we're just going to take the leap and move forward. So that was probably a moment where I kind of, froze and said, oh crap, wait a second, what are we going to do here? So
yeah, it's none of it's real until it gets accepted, right? It's just you submit an LOI or whatever you submit, and Until
Yeah.
that's accepted, it's just something on paper. It's just something that you think about, and it seems like a good idea. But then all of a sudden, when you you have to push ahead, you're like, okay, now I've got to figure out if I really want to do this deal.
Yeah, you fight for so long to hear yes, then you finally hear yes, and it's like, oh, is this what I really wanted? So it was definitely a little bit nerve-wracking on the first one, but we got through it. It was a great experience. I'm super happy with the property. So, if people come to that moment, just believe in your business plan, believe in your underwriting, and just push forward.
Yeah, very cool. Yeah, awesome. Before we go, thanks for sharing everything today. It's been a really interesting interview, finding about all the deals. You've scaled really quickly. I love that. Even though you've been involved for a while, you started really taking big action in 2019, and you've grown a big portfolio, I'd say, in that short amount of time. And there's no doubt that it'll keep growing from there. So I think that's really cool. But before we go, where can people find out more about you and anything that you have going on?
So my website is, my company is ARC Equity Group. It's arcequitygroup.com. My email is Brian, BRIAN, at arcequitygroup.com. So you can either go to my website or email me. I love connecting with people, whether it's investors, brokers, partners, anything. So I love talking real estate. So you can reach out to me either one of those places.
And then you guys also have a meetup, right? That's the multifamilymasters.com.
Yep, we're part of the Multifamily Masters meetup. Mandy and I co-host with our other partner, Kevin Dugan, and we do that the first Tuesday of every month, and that's at multifamilymasters.com. There are multiple meetings all throughout the U.S. We run the Chicago chapter, but they're all virtual now, so you can come on anytime.
Yeah, I've been to one. It's a great meetup event. I really enjoyed it, so I highly recommend anyone who has any interest to check that out.
Yeah, it's been a lot of fun.
Cool. Well, thank you so much, man. It's been really interesting hearing your stories today, man. It's really, I love hearing the stories about the deals and how they work and how, the financing. And the reason we were talking so much about financing today, that for anyone who's wondering, is that financing can really make or break deals, right? I didn't touch on that at the time, but what kind of financing you get on a deal makes a huge difference. It can really make or break a deal at times. So I think that's why and it's really interesting to see the kind of debt you guys had, what kind of business plan you have, what kind of stuff you've seen during COVID and everything like that, and kind of what's coming next for you. So thank you so much for making the time, man. I really appreciate you being here.
Thanks for having me. I really enjoyed it.